Hello friends, my name is Varun and today we are going to discuss about how can we generate monthly passive income using options. So this is one strategy which we can use and we can generate monthly passive income through options. So let's begin. Uh, couple of disclaimers. This content is purely for educational purpose and is not intended for any investment or for financial advice. So before we try to get into the strategy, let's try to understand the options basics. This is just for the people who are the beginner. I have made a separate video for understanding options. You can also refer that video, and we are going deeper in that to understand options. But let me just cover a couple of basics here. So options are nothing but a contract of 100 shares. So one option means 100 shares. Keep that in mind all the time. US options always deal with 100 shares. So, and these contracts have an expiry date and a strike price. And just like any other trade, there is a buyer and a seller of this contract. So, even for these options, we always have a buyer and a seller for each contract. So, yeah, and buyer buys at a premium and seller gets that premium. So, keep that in mind always. A buyer is going to pay a premium price for that option contract, and seller is going to get that premium. It works exactly like an insurance where there is an insurance buyer and there is an insurance seller. So if you are buying a car insurance, you are going to some insurance company and you are going to buy that insurance. So and they are going to charge you a premium, so you are going to pay that premium. So you are a buyer of insurance by paying that premium, right? There are two types of options, calls and puts. uh, Again, as I mentioned, all these details I have covered well better in my basics video, so you can refer that. So let's begin. So what is this strategy about, and how we can generate monthly returns using options premium selling? So as I mentioned, premium is nothing but a cost of that contract, where which is paid by buyer and taken by a seller. So as part of this strategy, we can become an option seller, and we can sell options monthly or weekly or whatever period is comfortable to you. You can decide your own period, and in that period you can start selling options and you can start earning premiums. So the the best part of this strategy and selling strategy is the time decay is in your favor. So every day when it passes, you actually keep collecting that premium more and more. So for example, uh, let me give you an example through the car insurance uh, thing. So let's say a buyer is buying a car insurance, right, for 6 months. So our insurance company has got a risk for 6 months from that buyer. Now, as that the car insurance will keep coming near to the expiry date, your your the risk of the insurance company is becoming lesser, because now they just need to take care of, let's say, 1 month or 2 months, and after that the contract will expire. So that time decay or that period coming near to the expiry date, that always works in the seller's favor. And similarly in options, uh, as we go near to the expiry date, we keep collecting that premium, and that's a wonderful advantage of this particular strategy. So, and when you sell an option, you are collecting the cash upfront, because you are working exactly like an insurance company. So you take that premium on day one when you are selling that contract, or that contract is happening between a buyer and a seller. So you are collecting cash on that day itself. Now after that, what happens, make whether you make a loss or you make a gain out of that contract as a seller or as a buyer, that happens on that expiry date. But before that itself, that credit comes into your account. So and now this is one of the strategies which I have found that where you can be wrong about the direction of the market. You don't need to do too much speculation about the stock price, and you can just play it smart, like just like an insurance company, and you can win most of the time. So the way insurance company works, right? Any car insurance company or house insurance, anything. So the way they work is they calculate probabilities, and you know um, they do the mathematical calculation in terms of that they always win, when they have multiple contracts or insurance running. So similarly, we can also be smart about our trades where we ensure that we are going to win through the probability and through those mathematical calculations. And I'll come to that how we can ensure that and how this strategy can be used in options. So Warren Buffett, one of the most successful investor of our time, he actually uses this strategy a lot, and you can see a couple of examples I have put over here. Uh, that he loves selling put and he loves to collect premium. And I believe this is just my personal belief. I think this is the main reason that he also owns Geico. He is a majority stakeholder in the Geico insurance company. I believe he loves this kind of business and this kind of mindset. So he also owns Geico. So let's move forward. So this is an example of NVEX. This is a vaccine company, Novavax, which are quite active right now in vaccine research for COVID. So if you look at this example, I sold this particular put. Put is one type of contract. I have sold one put. So P is for put. Minus represents selling, and one represents one contract. And remember, one contract means 100 shares. So I have sold one option contract of NVEX, basically which means 100 shares at strike price of 75 on Feb 19th expiry, which is 59 days away. And as a seller, as I mentioned, seller always collects premium. As a seller, I have collected $8.30 per share, which basically means I have collected $830 on this particular trade. 8.3 multiplied by 100 shares. Make sense? So uh, you should always be able to break down this ticker whenever it is shared with you on any platform. I mean, most of the platform will have one similar tickers, which will say sell to open or sold to open. They will say put or P. Uh, they will mention about the time and the date, and they will also mention strike price. Generally, this is how the ticker will be shown for the option. So so this is a trade which I entered, and I sold this put for 75. And when I did this trade on uh, 22nd of December, that time I believe the price of NVEX was around 115 to $120. Um, and this company, I am bullish about this company. I know that they are doing good in their vaccine research and manufacturing, and they have actually given a very big large they have got a very large contract from India, so they are going to make billions of vaccine for COVID. And I did share this on the internal group as well, uh, and I shared my research as well. So so let's deconstruct this one and understand how the selling strategy works in this particular example. So my strike price is $75 by Feb 19th. This is what we can see on the ticker. I'm collecting a credit of $8.3 per share, which is 8.30 over here. And number of contract is one, which basically mean 100 shares. So total underlying value means, so my total underlying value is nothing but $75, which is the cost of, which is the strike price multiplied by 100 share. So this is a value on which I am trading right now. If I'm going to lose and let's say this NVEX goes bankrupt, this could be the amount of money I could lose. Bit lesser than that, but let's keep it this way. Um, so cash margin requirement for this trade. So guys, this is important, and this is what is becoming is helping retail investors nowadays to do option trading as well as getting into the selling side. E- Since as you have already observed that and also have covered that in my previous sessions, a seller needs more capital because you are basically working like an insurance company. So if you are an insurance company or an insurance seller, you should have enough capital to manage risk. And if I if an insurance buyer, they come up with their own losses or their risk, you should be able to manage those. So uh, an insurance company should have enough capital to manage it. And how do they manage it? By playing it smartly, by always having making sure that they are going to win when there are multiple contracts, insurance contracts running in the place in the real world. So this similar way we should also play this game and have that mindset. But yes, for sure, if you are a option seller slash insurance seller, you should be capital intensive and it is going to be expensive in terms of even doing this trade. So earlier what was happening, a retail investor needed 100% of the capital just to do any selling option. So earlier this particular requirement, or even now on many platforms, this requirement is 100% of the capital. So guess what? If you need 100% of cash to run this trade, you would need around $7,500 to be there in your trading account and do this trade. Otherwise, especially like platforms like Robinhood, I think Robinhood and many other platforms, new platforms, they don't allow you to run on these to do these trades on margin. They will need you enough cash, so they will request you to have $7,500 just to do this trade. But there are other brokers who have started giving you margins, and now you can actually do selling just by 20% of the strike price. And again, it differs from stock to stock. If a stock is very risky, even that broker can make a change and they can update, make this particular limit for particular stock to 50% or even 100%. But what I have observed, 80 to 90% of the cases, broker will have this cash margin requirement around 20%. So in this particular trade, I am giving up 20% of my margin, or I need to have 20% cash margin to run this trade, which is around 20% of 75 or 20% of $7,500 will be $1,500. So I should have $1,500 in my account to run this trade. And how does that impact us? So basically, it actually impacts our ROI. So let me show it to you. So my return is 8.3 multiplied by 100, 8.3 which I have got here. So this is my $830. So what is my return on investment? So my return on investment is 830 divided by $1,500. Remember, I just put $1,500 in my account and I was able to execute this trade. So I got around 55% ROI, which will come by Feb 19th, which is around 60 days away. It is actually 59 days away. So, and my approximate annualized ROI is 55 multiplied by 365 divided by 60 days, which is around 365%. So if you compare it with other instruments where they provide you the annual ROI of 5%, 10%, banks are giving you 4%, 5%, and you compare 365%, it's a major big deal, right? So let's go to the next one. So on the same example, let's figure out what is going to happen on Feb 19th. And also we will also see how much probability we have to win this particular trade, because I am taking a margin, right? So taking a margin is also risky. If I'm going to lose this, um, I might have to, uh, I might have to give back that money to the broker. So in this particular scenario, I will have to understand what is my chance of winning and what is my chance of losing. If my chance of winning is very high, then only I should commit to this trade, right? So let's look at that. So on Feb 19th, if if this stock remains above $75, I am going to win this trade. Remember, this is a put. So I am selling a put and there is a buyer of a put who is expecting that this stock will go down or go below 75. But I'm just selling him the contract and saying, okay, you are betting that it will go below 75 and you are going to pay me $8.3. All right, here's the contract for you and I'm writing it for you. So I am taking his risk when this stock will go below 75. And by Feb 19th, if this stock is not going to go below 75, the buyer of this put, he's losing his bet, and I'm going to win. And when I'm winning it, I'm just going to keep this premium, which is $830, right? So this is a simple win case if stock remains above $75. So what happens if stock goes below $75? Now, interestingly, in this particular case, we can win or we can definitely lose too, right? So how does winning happens when stock goes below $75? So now we will have to understand what is our break-even price. So, and to calculate that, you should see that strike price is 75 and we have collected a premium of $8.3 per share, right? So our break even comes around 66.7. So guess what, guys? Until this stock on Feb 19th does not go below 66.7, we are going to win this trade. Only when this stock will go below 66.7, we will start losing in this trade. So this is the power of selling options, where you we are dealing with some particular strike price, but even then our break-even price could be way lesser than that. And even if we lose on strike price and we are still winning on the break-even price, uh, we are above the break-even price, we can still win that trade. So that is the power of this particular strategy. So above break-even, we are going to win this trade. But if stock goes below break even, stock goes even below 66.7, we will have two options. Either we can take the stock assignment at a strike price, or we can close the contract on the loss. So definitely this is a scenario where either we are going to take a loss, or we should have enough capital, which is nothing but $7,500, to take the stock assignment. Stock assignment is nothing but taking the delivery of the stocks from the broker. So broker is going to give us 100 stocks um, at 75 strike price. Irrespective of whatever the price is going on, it could be way lesser than that, but he's going to assign it to you at $7,500 since $75, since this is what we guaranteed as part of this contract. Make sense? So if we understand this particular scenario, this should be a breeze. That stock at $75, this is definitely above break even. So we are going to win this one. All right. So now there is another parameter in this case, and this is how when I do this kind of trade, I or use this strategy. This is the mindset I have why I'm doing this trade. So current stock price is $120, and as I mentioned, I am also bullish on this stock that it can go above $120, right? And strike of $75 is around 40% away. So guess what, guys? To to bring this stock to $75, stock has to do a lot of work. People will have to just crash this market, especially this stock, to bring it 40% down. And on the other hand, I am actually bullish on this stock. So I feel that this is a very good strike price as well as a very good credit for me, and I can take enough risk on this. So I am winning in this particular strategy, in this particular block above $75, stock at $75, and below $75 where I'm going to lose. This is 40% away. So this is a calculated risk, and I feel that probability of my winning is way higher in this case. Make sense? And strike of 75 is around 40% away, by the way, and break even price is further away, which should be around 48% away or 45% away. So this is the power of option selling, and you can use this particular strategy a lot to generate constant income, where you can remain away from the actual stock price. In this example, I'm like 40% away from the stock price, right? So I'm not speculating about whether stock will go up or down by one from $120. I am at $75, which is way away. People can speculate around $120 will go $100 or it will become $150. But I mean, by Feb 19th, if I have this stock above $75, I'm going to make $830 right away. And not I don't need to babysit this particular stock, that when should I enter or exit, and I need not to speculate at all. So this is the power of this strategy. This is how you can generate passive income without babysitting these stock trading. So let's come to the takeaways. So what we have learned here. So options work exactly like an insurance, at least for the scope of this session. Of course, there are multiple other strategies where you can use options for speculation and for to make money or to hedge your risk. Hedging is nothing but insurance though. Um, so, but for this particular session, you should see options are nothing but insurance. And options have got a lot of options. So you have got call, put and call, and you can use put and call as a buyer or as a seller. And when you combine them together, you can have a lot of options, and that's why this particular asset class is called as options. Uh, so option selling is one of the option trading strategy which can be used for passive income generation, which I showed you in this example. I love this particular strategy and I use it a lot. There are other strategies too which I use time to time, but this is one of the strategy which I use a lot because it helps me to generate passive income. I don't need to babysit. I don't need to look at these trades every day and decide whether I should exit or enter. I don't need to do any of that speculation at all. So, and one can make money in any direction or without being directional in options. So as I showed in this particular strategy, I'm not directional at all. All I'm thinking of that strike price, which is way away from the actual stock price. So I'm not directional at all in this particular strategy. There are other strategies where you can be directional and you can make more money, but this strategy is all about making a passive income without putting too much effort uh, or without doing a lot of speculation. So there you go, guys. So we have premium membership of our community. You can join us as a premium member. This will bring enough commitment from your side to learn options, as well as help us to invest more in our website, in content, as well as in community growth. You can also leave membership anytime. Feel free to register on moneywhileyouSleep.co if you are interested. I will also share my real-time trade alerts with premium members so that you will learn very fast, also earn at the same time. And if you like any trade, you can always follow and execute those trades. So yeah, this is where we are right now. I believe with this practical approach, you will be able to master options soon. So relax and enjoy. Our money is going to work hard for us, not us. Uh, do share and subscribe this channel. And if you have any feedback and questions, please feel free to share. I'll see you soon. Thank you.